All right. Hi, everybody. It's Megan's Monday Market Update with Matt Stancato here from Guild
Mhm.
Mortgage Lending. And today we're going to be discussing some moves Warren Buffett has been making recently that I find particularly interesting. He sold out some of his stocks, a pretty significant amount actually, from like Bank of America and Capital One. And he's moved about $3 billion into five different companies, and two of them are Domino's Pizza and Constellation brands, which would be things like beer, wine, spirits, Corona, for example.
Yeah, familiar, yeah.
Something I found interesting about this is these, to me, first thought, recession proof companies. I mean, on a large scale, Warren Buffett could have bought out all these companies in one fell swoop. He has that capital, he has that influence, but he's not, because he still seems to think that there's uh, an investment opportunity here with
Mhm.
just owning stocks in it. And I think it's interesting because during a recession, people are going to want to buy pizza. Domino's, arguably one of the largest pizza chains that's affordable in the country. And people are still going to drink. I mean, let's be honest,
Maybe
if a
even more.
recession's on the horizon,
Yeah.
people are going to be drinking wine and beer. um, which is counterintuitive slightly, because if the tariffs were to go into effect in Mexico, it would affect, Corona prices and things. So, yeah, what do you think about that?
Well, if tariffs went into effect and the prices went up and people were still buying Corona because it's a massively popular brand, well, that's an even better move for Warren Buffett than it would have been before.
Yeah.
And just because he can buy out these companies doesn't mean that it would be in his interest to do so. He doesn't want to be a beer owner. He wants to be a beer investor. So
Mhm.
buying an amount of the stocks that allows you to exert some influence on the company is sufficient, or just if he found another $1 million in his tuxedo pants and decided to go to Corona, whatever. But he is obviously one of the greatest, and most respected investors of all time. And I think that your view on this is not it's not off base at all. I think he's intentionally buying into what are recession-proof industries, and I think he was making some sales as well.
Yes. Yeah. I'm sitting here and I'm thinking about, you know, 2008, 2009, and
Mhm.
what, frankly, was my household doing? Domino's Pizza was number one, hands down. I don't know if there's anybody watching this who can agree with that, but I can literally think $5 pizza at the time
Mhm.
was unmatched for a family of four with kids, busy household, right?
I went back to a Little Caesars, so it was a little different.
A Little Caesars is, yeah. But nonetheless, that's exactly where my mindset went. Just right back to the house,
And you said,
Domino's. I credit card on file to order. So
"Hi, Megan." Yes,
it's us again.
he's but he also made some sales as well. He's selling off bank stocks. So the
Yes.
other half of what you're looking at also matches up. And this makes sense given where the economy is right now. In the past, every time we've had a massive inflation increase, it has taken a recession of the economy to right that. The most recent one that I can think of that actually had the really high spiky interest rates was probably 1981, where we had the inflation from the Carter at the tail end of the Carter administration, and then that was taken care of in the beginning of the Reagan administration. And of course, rates at that time were 17, 18% on a fixed. So it takes rates going higher from where they were, like they are now, in order to slow the economy to bring inflation back down. But what does slowing the economy do? Well, I know we all talked about, or a couple of years ago, the buzzword was a soft landing. The Fed was trying to negotiate a soft landing, meaning they want to bring us back to a good inflation and unemployment level, but without a crash, which would be a recession. Instead of it going along and doing this, they wanted to do that, which is what the Fed has been trying ever since. One way or another, however, the fee comes due. You got to pay the piper, and it's either
Mhm.
over a long period of time or it's over a short period of time. And the short period of time looks like a recession, whereas the long period of time looks like a soft landing. Either way, it's a slowing of the economy.
And do you think that we have successfully navigated a soft landing, or do you think that a harder recession is coming?
If you would have asked me 6 months ago, I would have told you we had, against what I believed was going to happen, that we had negotiated the soft landing. Inflation, however, is proving stickier than we thought, and that can be about a couple things. That can be about the rumors of tariffs. So it might be that, what Trump is doing is working against the market. It could be about general inflationary stickiness due to those weird CPI things that happened the last couple of months. The California wildfires and lodging away from home. The savings we're supposed to see on domestic production of gasoline, of course, hasn't happened yet. So that's a deflationary pressure people thought was going to come to bear, but has not come to bear. So
Mhm.
what you're looking at is it looks like the overheating of the economy, the coals are glowing a little hotter than we thought.
Yeah, yeah. I think I'm kind of on par with you. I felt as though we were navigating a soft landing here for a while because I feel like there were industries that were experiencing recessions. People were kind of pulling back. Manufacturing has kind of slowed down. People are getting more conservative. All of these things indicating, like, hey, we're entering this recession. People are preparing for it. And we have been on this journey now for a couple of years trying to hope for the soft landing. And I I come back to the tariffs a little bit because I really am genuinely interested in how this is going to affect the overall market. Is it going to work against us or push us into like a deeper recession or not? Or is it going to be good? And I think you could see the argument on both sides. The optimist in me says that we are not going to hit this hard kind of recession only because I like to believe the powers that be won't let that happen. Knock on wood. This is not a common perspective. I'm aware of that. The narrative right now is very much people feel that we are going to hit a harder recession, that it's going to get more difficult. So my only advice to that is, if you are listening to this, prepare, be educated, learn about what's going on, and make good moves for your family. So,
Yeah.
but back to what you were saying.
Well, I just got back from the Guild Mortgage President's Club meetings that happen once a year. It's a leadership summit where the a bunch of the LOs from the company go and meet with the leadership. And one of the things that we get to do is we get to talk to a guy named David Batney. David Batney is a 20-year veteran at Fannie Mae. Then after that, he came to work for Guild, and he is, if NASA had a question about where rates were going to go, they would call David Batney. And so we have him coming in on March 13th, I believe, this year for an event. I'll put a flyer. I'll give a flyer to Meghan so Meghan can post it as well. It's open to the public and to industry professionals, depending on who wants to know what the rates are going to do. But what Dave told us in general was that whereas we went from an environment where we anticipated 4 rate cuts this year, we're now going to an environment where we may anticipate 1 at the end of the year, but more likely 2 next year. So the long, slow rate decline makes a lot more sense with a long, slow economic recovery or a long,
Mhm,
slow economic slowdown than it
mhm.
does with a sudden economic crash, where you would have to lower rates in order to try to get the darn thing moving again. So
Right.
because he sees that, I think that he also sees concomitantly a soft landing. So that should be good news for
Yeah, it is. And if you the reason I was excited a second ago is because if you listened to our video a few weeks ago, I predicted maybe 2 rate cuts this year because I personally didn't think that there was going to be that many. So it's kind of nice to hear that somebody else is with some credentials is seeing the same thing.
Got all the,
Um,
but if you want to know more,
I
please come out to that event because it's free and he knows everything there is to know about the rate market. If you're looking for timing, he's the
I love that. I will definitely stay. I definitely want to attend and hear what he has to say. So, but this is all good news because even a minute ago before we started rolling on the camera, you had shared with me that the real estate market tends to be ahead of
yes.
other markets and that we are kind of positioned where we're kind of peaking out right before the descent. So talk more about that.
Yeah, the way it's always happened in my 22 years of doing this is that the real estate market either precedes or proceeds, depending on what kind of move it is, the rest of the market by a little bit. And that's because we are very, very rate dependent. So the rates are the tool that's used. So in order to change the direction, let's say, of inflation or of unemployment or the economy. So in our case, because we move directly when the rates move, we're sort of a leading indicator. So when things reach a certain point where now we're in trouble, well, they say, okay, we're going to drop the rates, and then immediately our industry starts to come alive again, and our industry starts to kickstart the rest of them because home ownership is such a huge driver of wealth in the country. So that's one of the reasons it ends up working like that. And it's encouraging for people who have been on the sidelines for a long time and who have been waiting for things to go on the market. As these rates drop, all that's going to bloom.
Yes, absolutely. And this has been a narrative that has been at play for a while now, which is people trying to draw comparisons between the market now and 2008, which is why I bring it up so much because it's just people are looking for similarities, right? But one of the, I would say the two main differences, if you're somebody listening to this, is there were a lot of predatory loans in
Yeah,
2008 that really influenced the market. Um, a lot of foreclosures and things like that. And then secondly, there was a lot of building happening. There was kind of a surplus of homes on the market.
mhm,
And now we're kind of entering this soft landing, this kind of recessionary period, and there's a housing shortage, which
mhm.
puts us in a different position. So if you're somebody who is trying to draw comparisons, please take note of those differences, right? Because Matt, I'm sure you can speak to this. That's a big reason why arguably the housing market is still hardy, right? It's still pretty strong.
The hardy
People,
market.
yeah.
Our comp. Sorry, there's a little bit of a delay. I didn't mean to take over. We got our industry is predicting a 33% increase this year. So even though we had what was a pretty significantly bad 2 years, um, regardless of what is happening in the interest rate market, we are still predicting an increase. So yes, I think the housing market is still hot. And
The housing market to me has maintained its strength
yeah, versus
through
2000.
this
Yeah,
because of the housing shortage, because
yeah.
there's not a surplus of options, right? Which is why property values are holding pretty strong within a specific range. Like, yes, we're seeing price reductions, yes, we're seeing inspections and other things, but you're not seeing this significant like $100,000 drop in property values. You're not seeing properties that are sitting longer, usually on average, than 3 months. I mean, it's still relatively a strong market because people need a home, and so
Well,
yeah.
in the mortgage industry, we are actually very optimistic about where we're going in the coming year. And we compare this to 2008 as being the exact inverse of 2008. In 2008, our problems were we were overbuilt and that money was too easy to come by, right? And which was inviting a whole crop of loans that eventually failed and shook the underlying market. We can no longer make loans like that. Lending now has a minimum. Um, it sounds silly, but there are laws now that require you to make certain calculations about the person's ability to repay the loan to make sure that they are likely to repay it in the future. And that's always the way we operated. Some lenders did not, because you now are required to do that by law. There are much fewer loans that are shaky, that are on foreclosure grounds. There was a huge foreclosure spike. That's not happening in 2008. That's not happening right now. And in 2008, there were more houses by a long shot than there were people who wanted to buy them. And now the opposite is true. That's going to do nothing but support value. So if you're looking at, yeah, our value is dropping a little right now, you're giving back $10,000 in seller's assist from the 70 grand you gained last year in equity. It's that kind of thing where, yeah, you're seeing the top of the market flutter a little bit, but in general, it's still a long, slow, steady ride up.
I agree. That's exactly where I was going with this.
Yeah.
So
You edit my whole thing out because it was terrible.
no, no, that's exactly where I was going with this because I think people get nervous.
Yeah.
And when I'm having conversations with buyers, it's like they feel the pressure. They want to make a move. They want to make a purchase. They're not sure. Is it affordable? Things like that. So
With determining affordability. If somebody doesn't know how much they can afford and you're not ready to buy yet, you don't like where this market is, we're still happy to meet with you. It's no charge, of course, ever. And we'll let you know where you are, where the credit's at. We can do it with a soft pull so it doesn't affect your score. And then we'll take a look at your income with you, even if you're self-employed, and we'll put it together. And if you're self-employed, you don't make enough yet, we can even help you with some general advice on how to put your taxes together such that you can show a little more of that income to a mortgage professional.
which is wonderful. I'm going to sound a little bold here saying this one, but at least in the state of PA, Chester, Montgomery, Berks County, you will never see home prices down at 150,000 again, a 4 bedroom, unless it needs a significant rehab cost. I have a particular buyer who has waited for the last 5 years thinking that the market was going to come down and they were going to buy a house cash. And I love the sentiment of it, but they don't want to take on a massive rehab. And, there's this kind of false narrative floating around that the market's going to make this significant crash and people are going to be able to buy in and buy in. That's probably never going to happen. I mean, I just want to put that out there. And like, if it happens, feel free to tag me and say so. You can totally rub it in my face. It's fine. Like, my feelings aren't going to be hurt, but that will probably never happen here. Different market, different state. I'm not talking about that. But
Yeah.
what I am saying is here, that will probably never happen.
Chester County has routinely for the last 30 years been one of the top 10 most desirable counties to live in the country.
Yeah.
And the counties around it, of course, they benefit by that halo effect. And anything in southeastern Pennsylvania outside of certain neighborhoods around urban Philadelphia are never going to see that kind of decrease.
No, and with this should be encouraging, right? Like this information shouldn't be a discouragement, like, oh, well, then I don't want to buy. This should be encouraging in the sense that there is this upward projection in price values, meaning that if you get in at really any point, as long as you hold the property, you're going to gain equity. You're going to gain value in your home. You're not in a shaky real estate market where you're nervous if you're buying at the high and it's going to drop. Like that's not going to happen.
In one of Warren Buffett's books, since we're both fans, and we
Yeah.
have it with this: if a stock only goes upward, there is no bad time to purchase it. You
Yeah.
can't lose. All you can do is wish you had done it earlier.
Yeah. Anyway, thanks for tuning in, guys. Thanks for listening. If you have any lending questions, if you're curious about what you can afford, where things are going, feel free to reach out to Matt. I link his contact information in the video below, along with my information. So feel free to give us a shout. Like I've said before, Matt is nationwide with Guild Mortgage Lending. So if you're in another state, doesn't mean he can't help you or facilitate getting you connected with somebody who can. And happy Monday, everyone.
Thanks for having me.